Welkom bij een nieuwe KoersKompas podcast. Vandaag heb ik Daniel Want te gast. Hij is de CEO van Prerequisite Capital uit het verre Australië. Daniel, thank you for coming on the show.
Not a problem.
Let's maybe kick it off with the usual introduction.
No worries. Well, my background is kind of in funds management, hedge funds, and about 13 years ago, we started our own firm, Prerequisite Capital Management. Largely, we manage money domestically, predominantly, but we also do research largely for an international audience. That kind of came about 10 or 12 years ago, where with a lot of our research being picked up overseas. And so we have a globally focused research business and a domestically focused money management business with largely conservative sort of mandates in terms of what we do for clients. But on the research side of things, we've evolved over 10, 15 years, a variety of tools where we can basically start to see where larger money are buying and selling in any given securities market. And also we spend a lot of time trying to learn how to map capital flows between countries, between regions, between asset classes, in and out of securities even, and trying to gauge a better handle on actually being able to operationalize typically what can often be abstract concepts or concepts that require a lot of proprietary data sets that a lot of the banks are not necessarily going to be too keen to release. And so we've basically using a systems theory sort of concept, we try to triangulate what is going on in terms of the way money moves around the world and the way larger money is positioning. Big money tends to use or leave a lot of footprints in markets. And so we've spent a lot of time learning how to pick that up. We also have spent quite a bit of time over the years just running down a lot of rabbit holes with regards to the globalized banking system and different more obscure sort of topics. And so that's a short version of what we do, I guess.
Yeah, a lot of macro investing. Let's get your thoughts here, maybe your overarching view here, your thoughts on the global economy as of today.
So I'll give you, say, a few minute overview, and then
Sure.
you can pull on whatever threads you want. So when we step back, literally multiple, so a couple of 100 years, we are basically in a sovereign default cycle, which can last anywhere from 10 to 12 years on average throughout history. These sovereign default cycles typically happen every 40 years, where you tend to alternate between a minor cycle and a major cycle. So every 80 years, you get a big one. The last big one we had was back around the World Wars, where we had, especially World War II, where we had a large preponderance of countries in the world, nations around the world, defaulting in some way, shape or form, either letting their currencies go or their bond markets in different versions of default. That sort of process, we've developed leading indicators for that track back quite well for the last 130 years, roughly, that give us a 10-year leading sense for where we are in that sovereign default cycle. The short version is that we, at least according to that methodology, if history is any guide, we see this current sovereign default cycle in the world top out in the early to mid 2030s. Right. And so that kind of sets a bit of a backdrop, and we're already seeing the pressures. The problems with sovereign default cycles always start at the periphery and they cascade towards the core, towards the center of the system. In this case, the center or the core of the system is still the US predominantly. And we're already seeing the beginnings around the world of peripheral nations having different problems with bond markets, currency markets, and actually some of the major regions of the world are already starting to have these problems as well. So basically governments around the world have run out and are running out of room to move. And so that sets a bit of a backdrop. What that means is that the last 40 years in markets is not going to, the next 10 years is not going to be like the last 40 years in markets, because we've got a materially different regime in play. Typically, when you see these default cycles, especially the major ones, you're also seeing globalized conflict and breaking down in trade and all of this sort of stuff. And this creates disorientated capital flows, desperate governments that tend to get a little bit more tax hungry, a generalized broader context of deteriorating rule of law and jurisdictional risk. So when you are looking at different regions, or particularly when you're, so we're looking, I know I'm jumping around a little bit, but we've been doing a bit of work in the natural resources space, getting ready for potentially another cycle there. But half the analysis, I believe, moving forward is going to be more a bargaining power style calculus, where you've kind of got to be in a world with escalating jurisdictional risks and rule of law risks, issues, tax hungry governments everywhere, propensity or higher sort of risk conditions for expropriation of assets or punitive taxation, all of this sort of stuff, nationalization of assets. You kind of need to be sort of 50% investment manager, 50% mafia cartel style manager logic, just to try and make sure you don't end up on the tail end in terms of having your assets potentially compromised, expropriated, or extorted in the different regions moving forward. That sort of thing. That the second thing that's going to define this sort of set of conditions, especially over the next 10 years, is the increasing preponderance of capital controls. As a lot of the governments and currency systems start to struggle, they're going to try and ring fence the capital that's in their countries and systems and start to make it harder and harder for capital to move around the world. What people probably don't appreciate is that capital controls, as they start to take off and gather pace, are going to strike a stake to the heart of the current passive and indexing style strategy approach of a lot of large pools of money. Because then all of a sudden you're talking about a world with the very real risk of stranded or impaired capital. You can have an allocation to some sort of index ETF product and all of a sudden have almost overnight or within months have large proportions of that index exposure effectively locked and inaccessible, or have restrictions placed on big chunks of that capital. So there's capital impairment risks or stranded capital risks as well that are starting to build, which are largely not on everyone's radar screens. And so learning how to understand and see the movement of money is going to become incredibly important in this broader context, because there's always larger players and there's always pools of capital that have closer proximity to what's really going on, real information, that will tend to move ahead of the news, so to speak, ahead of when capital controls get placed or different issues are about to manifest in terms of changed government policy or different issues that are going on with companies or industries, et cetera, et cetera. And so we spend a lot of time trying to look at that. So that's kind of the backdrop to set the scene, so to speak, for the next 10 years. And then within that, more immediately, we've got a lot of methodologies that are suggesting the next 2 years as likely to have the hallmarks of a non-public or a private market credit default cycle, basically. So non-public debt, so corporate credit, mortgage credit, and other sort of package loans, banking, household credit in different parts of the world. A lot of our leading indicators are suggesting a high probability of the next 2 years seeing a bit of a default cycle unfolding or cascading through the world, the beginnings of which we're starting to see, but it hasn't fully manifest yet.
So how do you guys how do you guys position for that? Are you guys bears? Are you looking for blow up type of trades? How do you play that?
Well, in the money management side of things, we run a fairly resilient mandate where we're trying to loosely, in a conservative way, make money irrespective of the seasons that we go through, not correlated to risk assets as such. but it's more of a real return resilient style focus. And so we simplistically start with a concept where every single asset or market or currency in the world is either maps to like a collateral set of characteristics or a confidence set of characteristics. So it's either a confidence asset or a collateral style asset. And you can simply tell the difference between when there's stress or confidence is falling or sort of a risk off type conditions are happening. Collateral style currencies or assets get a bid, they do well. And vice versa, confidence style assets. And so we tend to be a little bit, at least in the money management side of things, we tend to, on average, be a little bit skewed to collateral style exposures, which would see us do well during any turbulence, especially if we end up with a little bit more of a pronounced credit default cycle in the next 2 years. But overall, we're looking to use that opportunity to actually just step into a lot of equity style exposures anyway. We typically work according to the old principle of, well, we call it a storehouse principle, where it's kind of modeled off the book of Genesis, actually, where you have the 7 good years, 7 bad years. But every 7 to 10 years in the world, you tend to get a cyclical progression where you have good times, bad times, all the rest of it. And we want to be resilient, especially as we're getting later in that cycle. And we tend to want to have more collateral assets than anything else, especially going into these potential default cycle phases. But then we want to open up the storehouse and accumulate assets. And hopefully that's what we'll be doing over the next 2 years if we get further volatility in broader markets around the world as a result of the storms that are brewing.
I suppose you're not too worried about the risk of inflation then, or am I saying that wrong?
We probably are more cognizant of potential downside surprises over the next 12 months.
Yeah.
But as the time frame blows out, then clearly it's more of an upside surprise. But that's more loss of confidence in currency regimes and institutions and all of this sort of stuff, creating. Also, not to mention the sort of breakdown of the global trade environment and all of this sort of thing. So that will tend towards tailwinds from an inflationary point of view as the time horizons blow out. Temporarily, though, there's probably some downside surprises potentially in the season ahead, but we would view them as temporary if they do occur.
Yeah. I got a lot of stuff about commodities. Before we get to that, you have any thoughts on the American markets here taking a backseat to the international markets? And do you think that's something that will continue here in, let's say, the next 12 months or so?
The short answer is I don't think that will continue over the next 12 months. The reason being is we spend a lot of time tracking capital flows, triangulating the movement of money between or around the world. The short version of what we're seeing, especially with regards to China over the last 9 months, is basically coerced inflows back into China. So government policy-driven repatriation of capital, more or less. However, we're also seeing, let's call it uncoerced money continuing to get out of China, right? And so it's kind of like any institutions or pools of money that are sort of ring-fenced and susceptible to Chinese government flexing of their power, so to speak, is having repatriation pressures coming in. The rest of the money, private sector, anyone that's less susceptible or have a capacity to get around that are getting out in a pretty strong manner. And so what we basically see is a temporary blip in a sense. Big money, the larger money in the world are using all of these bounces in Chinese assets and even the currency relative to most currencies. Any bounces that have occurred, they typically are using those rises to get out to sell into. And so it's a bit of it's a dual story going on. So you got the coerced capital coming in and the free or the more free capital to the degree that it can is going out. That's a vote of no confidence, clearly. But before that, before the last 12 months, we've just had a persistent situation of, for the 2 years prior to that, just net capital outflows in an unrelenting manner, irrespective of, you know, the new stimulus measures that they announce every 6 months and whatever. But it's basically a consistent vote of no confidence all the way through. And then even today is the same story. Now, interestingly enough, it's the same story in Europe right now. So there's a, let's say in terms of what we're seeing in the modeling that we do and the way we track the money, there's that coerced factor of money being repatriated. At the same time, there's a pool of money that we can only attribute to, say, is more politically motivated or aligned. That's going back, but the broader evidence suggests to us that the uncoerced and the broader big money are actually using these rises in the euro to actually exit. And it's a similar, slightly different story to China. And so we don't see this situation. And when we look at the capital flows relating to the US system and the US dollar, now all of this we have data sets for, right? So in our research business, we actually present a lot of this data so clients can see it for themselves. And we run through it in the videos and all of this sort of stuff. But for the sake of this, you know, unfortunately, just going to, well, these are the conclusions of our analysis, so to speak. So when we analyze the US, we're seeing fairly unrelenting capital inflows, but on our higher frequency metrics, we've had basically what amounts to a normal pause that refreshes, right? So we've got temporary high frequency outflows, especially the last couple of months from the US, the last 3 months in particular, roughly. But no different to what we've seen at every other pause in the multi-year bull market in the US dollar over the last 12 to 13 years, right? And in fact, we seem to be at a situation that is very similar to those sort of sub-cycle lows, or approaching a sub-cycle low condition, say in the US dollar versus most of the major pairs. And we see that in the flows. And that's kind of the opposite temporarily of what's happening, especially with the China and European story. Now, Japan, slightly different story yet again, where we see coordinated efforts from authorities to try and so intervene and maintain some measure of strength, or, you know, bid up the yen from time to time, especially over the last 12 to 18 months. But every rise in the yen, we're seeing huge institutional selling. So it's kind of like big money using every bounce in the yen to get out still, right? And so what we basically have, and this is kind of a different story, but it's a different analysis framework that we run through with clients, is basically the euro and the yen are structurally broken currencies, right? And they're kind of starting to lead the way in terms of the beginnings of this sovereign default cycle. And we see this in the flows, we see this in the positioning, we see this in the nature of, well, we definitely see it in the data sets and the nature of the analysis methodologies that we track. And so what this all amounts to is a situation where it's reasonably probable still, and of course we always hold forward-looking views kind of loosely, but at least we have a benchmark to assess against. 12 to 24 months from now, it's still actually more probable that the US dollar is much more stronger against the majority of those major currencies that we just mentioned. Gold's probably a slightly different story, but in terms of just currencies, that's, I guess, the short version of what we're seeing in the flows data and the big money activity, etc. Obviously, a lot of that is fairly counter narrative, but big money movement tends to always be that way. So whatever is popular in FinTwit and the popular narratives out there is usually just either the entry liquidity or the exit liquidity for big money operations. And
right.
so...
how active do you think the Fed is going to be, the Federal Reserve, and also in, let's say, the next 12 months? They should be cutting very aggressively, I think, the next in the year.
Yeah. So as the next 12 months unfolds, we see it more likely for more aggression towards cuts to come in. We don't know when that tipping point will hit, but at least probabilities are skewed in that way in our view, you know.
Yeah. I gotta talk about one of my favorite sectors here as well, of course, commodity prices, commodity sector. And before we dive into things like gold and uranium and all that kind of stuff, let's maybe get your overarching view here, because I'm really curious. You think the dollar's going higher, maybe rates are going lower? There maybe a little bit of a cross currency, confluence here of some bearish things, some things that are rather bullish. What are your thoughts here on the commodity complex? How constructive are you, or are you not at all?
Basically, we're in a mode where over the next 12 months, we'd love to be accumulating more. We're a bit light on. We've only sort of dipped toes in the water in a sense in a lot of the commodity space.
You're expecting to be bullish.
Correct. But my suspicion is we may have better prices to step in at first. But we're not, there's plenty of things that are sort of showing the early phases of becoming attractive and setting up. But at least according to our methodologies, it's still probable that we're a bit early on that. But I would anticipate over the next 12 to 18 months, I'd like to think that we've accumulated a fairly healthy exposure to that broader space. And if that's the case, then we probably will be anticipating that we maintain that exposure probably, for at least the next 3 to 5 years.
What is going to drive this higher? What is going to take commodity prices higher here in the next, few years or during the decade?
Everything from the capacity cycle that is getting tighter. So I believe on a multi-decade basis, we're kind of coming into conditions that are reasonably tight from a broader commodity capacity point of view, both especially in the industrial metals and then also in the energy space globally. And so on balance, we'll tend to have more tailwinds rather than headwinds from a capacity cycle point of view. We'll also have, if we do get a bit of a squeeze higher in the US dollar, and that tightens some of this space a little bit, at least shorter term, if it occurs, there's going to come a point in time over the next few years where, like, we've basically seen capital concentrate into the US system and the US dollar assets in an unrelenting way for the last 14 years or so. There will come a time in the years to come where that reverses course and you start to see an exodus and capital disperse away from the US dollar and US system. Now, whether that's 9 months away or 2 years away, or I don't know, that's why we measure it in data and wait for it to actually turn and tell us. But when that does shift course, that'll be rocket fuel under the natural resource space more broadly, and then also precious metals as well. And I think if and when that happens, that's when you really see the big legs up in precious metals. I don't think we're really even on a multi-year basis. I don't think we've hardly begun the bull market in precious metals just yet.
Is there also some
we're waiting for that?
Sorry. Go ahead.
We're waiting for the rocket fuel conditions of capital finally exiting the US system on earnest in mass. And we're just not there yet. And I doubt that we see that in the next 9 months. And so somewhere in the next 9 to 24 months, possibly, is when I suspect we could see that turn of capital start to finally exit the US. Like, if we do have a private credit default cycle over the next, say, 12 to 18 months, that will still tend to drive capital towards the US dollar. And that will tighten banking conditions. That'll cause a whole heap of drama. And that could hopefully set up better prices for us to accumulate bigger positions in resources and even the gold sector, etc., including uranium, past a point. Yeah. But And so when that tide shifts, because most of our, so we kind of view it that there's still an upcoming tectonic shift of capital away from Europe into the US. Now, that'll probably be the last hurrah of this multi-year, this 15-year capital concentration into the US system. Probably it'll be flushed out over the next 6 to 9 months, especially if there's a default cycle in the world, or we get escalating conflict over there. And there's a few other things as well that are kind of bubbling away in the background, even in the banking systems, which could spark that final stampede. And that would also explain a lot of the big money positioning that we're seeing, using all of the rallies in the euro versus most currencies to actually start to lighten up and get out. And so eventually when that capital exits the US and starts to meaningfully exit the US dollar, that will be a very, that'll be a crazy world to be in on the one hand. And jurisdiction risks and capital controls will be potentially a bit of a problem. There'll be disorientated capital to some degree, but overall that should be rocket fuel for natural resources more broadly, and the precious metals sort of theme, generally speaking. And that's really when, on the other end of those sorts of conditions, maybe 3 to 5 years from now, with the tailwinds of that capacity cycle in the broader commodity space. And then obviously if you end up with conflict escalating in the world, which unfortunately is a reasonable probability, then they're 3 pretty substantial tailwinds to a natural resource biased set of exposures, when you put those 3 things together. And so I don't think we've really seen the beginnings of it just yet, even though gold's had a bit of a run, but most of the rest of the space hasn't really even started in a sense.
You'll be looking more to the underlying commodity itself, or would you be looking at the equities, maybe the developing companies or so, where to take exposure if you're looking out longer term?
Yeah, both. But it just depends what's happening. Like for the last 18 months, we've been like in precious metals. At the beginning of last year, we re-increased in a fairly substantial way our exposure to precious metals, but that was very spot gold kind of biased, for a variety of different reasons. That has worked, but after I still suspect we're a bit early on really stepping back into things in a bigger way. But when we do step into it, my suspicion is it'll probably be more equities than spot commodities, is what we use at that point in time. But up until now, especially because a lot of the rise in gold, for example, has been collateral bid related. And in that sort of a collateral bid environment, the equities are not really going to work. But past a point, especially if we have a little bit of a clean out over the next, say, 9 to 12 months, perhaps, then probably we would have conditions that are ripe again for perhaps equity style exposures rather than spot commodity exposures to be working. But we'll see what happens.
Right. Let's switch over to a topic that I actually know something about. Let's cover uranium here. What are your thoughts here on this cycle? What should investors expect for the next year or 2 years?
Yeah, so uranium, we ended up getting in a bit too early in that story.
Me
I think
too.
it was back around 2017 or 18 or something. It still worked out very well for us. And we recently, well, I say recently, but it was more like a year or so, 12 to 18 months ago, lightened up a fair bit on that broader uranium story and thesis. Just got a bit too rich by most of the different frameworks that we run to. And so we're kind of on the sidelines at the moment. The broader uranium story, however, at least in my broader generalized view, I would suspect we're maybe 40% through that broader uranium cycle, potentially, or 40% of the way through the broader multi-year uranium opportunity. So especially if we get any downside washouts over the next 6 to 12 months, uranium will be on the short list again to step back into. We're just not getting the signals that we look for according to our frameworks in terms of big money positioning and different other analysis methodologies to be stepping in just yet. But I would anticipate it's definitely on the watch list, but somewhere over the next 3 to, 18 months, I would hope that we're back into that story in some way, shape, or form, because I think the broader backdrop is still very much got a lot to play out still. That's the short version anyway.
Yeah.
But temporarily, we've been a bit just looking at other things, basically.
Yeah. I mean, the overarching view, I suppose, on nuclear and everything is getting clearer by the day. It's very obvious to one could argue that nuclear is having its renaissance, as they say.
Yeah.
Let's cover Bitcoin here. It's resting above $100,000. I suspect you are a bull.
So on a long-term basis, and multi-years, as the rest of this decade plays out, I think there's a non-trivial risk still, and it's not a popular view, I get it, that crypto more generally has a bit of a head-on collision with government agendas. I don't tend to think that crypto is going to survive a clash with government when government finally introduces programmable currency in their own right. Could be wrong. I wouldn't want to bet the farm on this view, so to speak. So generally speaking, with crypto, we tend to just view it as a tradable asset, something else that moves, lots of volatility, and wrap a risk management strategy around it and go for it. If you're going to take a position in crypto from our money management side of things is more conservative, resilient style thing. So any clients who are interested in that space, we tend to suggest to them to think of it a little bit more in terms of putting an option in your portfolio. You're at a reasonable risk of not having a good result to that exposure on a multi-year basis. At the same time, it could also go up by 5, 10, 15x, and so just make sure that you're comfortable with that almost an existential risk, even though, and when I say existential, it's just when governments, if they start to introduce programmable currencies in the context of capital controls and trying to ring fence populations and different economic entities and actors, I don't think they're going to be very much tolerating the crypto universe.
A little bit of an existential crisis.
Correct. And so maybe they're not rendered illegal, but they may be punitively taxed, or they might have other regulatory aspects to them that start to put a real dent in the demand for them. Now, it doesn't mean that they can't go up a lot between now and that point in time. But I kind of, on a multi-year basis, every further we go out from a time horizon perspective, the more I get concerned about a head-on collision with government agenda. Because I see it as a when, not if, government issues their own programmable currency. And in the broader context of, like we started, of a sovereign default cycle slowly rolling through the world, or coming to a boil over the next 10 years, basically, that is going to probably put crypto in the crosshairs at some point in time. In the meantime, it's a great thing to trade, wrap a risk management thing around it, and go for it,
What it seems to be really correlated to is something that you're also very, very familiar with, which is liquidity in all its forms. It seems to track that very, very well. Can you explain maybe why that would be the case?
Well, it's just that marginal set of liquidity conditions. We've seen, obviously, in a sense, it's a supply constrained individual dynamic, even though as an asset class, it's not necessarily supply constrained, because copy and paste will launch you another 100 crypto variants, etc. But individually, especially when you've got a network effect happening, then marginally loose liquidity conditions in the world will put a bid under, it's not much more complicated than that.
Because correlation, I've seen like some of these charts, like this correlation is like 99.7% or something. It's doing exactly the same as like M2 and whatever. It's crazy.
Yeah. So Raoul Pal
Yeah.
has done a lot of work on that, and he's been ahead of the curve on that
Michael
space.
Howell.
Yep.
Yeah. Interesting stuff for sure. Some other type of questions here that I've left here. What is the most overlooked opportunity in markets today?
Well, I guess it depends on your mandate and your risk tolerances. But the answer I'd probably have to give, at least on a shorter multi-quarter basis that'll get me into trouble, is probably US Treasuries. However, at the end of the day, past certain lines in the sand, it's not something that you want to hold on too tightly if that trade doesn't work. But I can't think of a time, at least in the last 20 years, where I've seen treasuries more hated, and yet they're not making new lows. And so by most of the different metrics, and all we see is big money accumulation, and probably every second, well, there's very few treasury bulls left. And so that sort of negativity tends to at least get me sitting up and paying attention, especially when I see the confluence of very large money accumulation at the same time as incredibly bearish narratives going everywhere. And at the same time, when you look at the longer duration bonds, they're not necessarily making new lows in price or new highs in yield, yet the negativity is off the charts. That's usually a setup that you want to pay attention to. Now, you still need to risk manage that, right? And maybe we are in a nonlinear environment. This time's different, blah, blah, blah. Sovereign credit risk has been increasing in the world, and that's been at the heart of what's been going on in sovereign credit markets, especially the last 2 to 3 years. That increasing sovereign risk premium coming into bond markets. The difference is with the US is that it's not necessarily showing up in the currency either, right? You don't really have a sovereign credit risk issue until you're watching both bonds go down and the currency go down in tandem. And when I say down, I don't just mean a multi-month or multi-quarter move that is not really knocking out any lows. You're talking about big legs down, and the sort of thing that you've seen over the last several years in like Japan and Europe and whatever, where you're starting to see the beginnings, and actually a lot of peripheral countries, a lot of emerging market style countries, where you're seeing higher yields or lower bond prices and substantially problematic currencies. You're not seeing that in the US. You're seeing a US dollar that, despite all the negativity there too, and bearishness, is still roughly, it's kind of holding lows. It's not necessarily making new substantial lows on the currency front, and neither are the long duration treasury bonds. Now, I'm not saying that you go and bet the farm on this, but at the same time, it's very incredibly underloved. I'm watching bigger money accumulate both of those things. both the currency and the treasuries. And we have a whole world of potential surprises over the next 12 to 18 months that could put, well, wrong foot the consensus right now, both on the US dollar and on treasuries. And so that's probably unpopular. I don't know what you phrased it as, unloved or overlooked area at the moment. And I know it's unpopular because it gets me almost into a bit of trouble, even with my own clients talking about treasuries. And so there you go. That would be an answer. But more broadly, I'd be on a multi-year basis, then I'd be looking in the direction of energy, potentially. Is something that's quite unloved and overlooked, and on a larger time horizon, something that we're very interested in.
Right.
Hello?
Yes. Oh, seem to be having a little bit of a connection.
I'm not sure if you can hear me. You're frozen and I can't hear you.
Oh. Go ahead. Sorry for the interruption.
Yeah, so probably on an overlook basis, on a longer term basis, we are tending to look in the energy direction. On a multi-year basis, different things in the energy space is sort of starting to become interesting to us. At the same time, actually, there's lots of things, particularly with that resource style theme, that kind of seem interesting on a multi-year basis. And so plenty of things there, which we've kind of touched on briefly.
Yeah, absolutely. What trends are out over their skis?
Anything that is hoping that these passive flows and indexing style conditions are going to continue to work. They're well and truly over their skis. I don't think they appreciate the risks of potentially stranded capital and other issues, capital impairment, actually, in the years to come. There's huge issues there that can completely change the landscape of investment markets. That's a huge issue. Another one that I don't think investors, especially smaller style investors, are appreciating is paradoxically, and I wouldn't have thought this would be the case 5 years ago. 5 years ago, I was looking at a future with just abundant data everywhere. Free, measure everything under the sun, and more data than you know what to do with, right? I'm starting to realize now that, and we've been watching this and concerned about it over the last 18 months, and it's been made worse with the introduction of AI. Data is becoming a problem, and I don't think people appreciate what this is going to mean. I'm watching, like with what we do over the years, we've been watching a consistent trend to seeing data becoming more problematic, especially if it's government collected and reported. So it's more likely to be doctored, more likely to be delayed, or more likely to be discontinued, right? And the revisions are just getting ludicrous as well. And so a lot of the data that's being collected, especially at a government level, is becoming increasingly problematic. And if we're going into a world with increasing sovereign credit risk over time and increasing risk of conflict, then you can expect those data problems to continue. Now, with AI, anyone who has proprietary style data access or collection or data sets that they own or collecting or producing, that's the new gold, right? They're starting to put gates on that, to restrict it, or to put huge price tags on it. We're seeing inflation for the price of data just really kicking off because the compute side of things is becoming very much commoditized and ubiquitous in a sense. And so a lot of it comes down to quality of, garbage in, garbage out type principle in terms of the use of AI. And so people who have unique and proprietary data sets are increasingly incentivized to actually not let those data sets get out and to restrict it or to price them out of existence in a sense and to use them internally. And so we're probably, when the capital flow conditions start to shift meaningfully away from the US, it's probably the time when you see things like Bloomberg potentially even go bust. Like they're in the crosshairs of a lot of pressures. Now, where this becomes practical for the average investor and even anyone other than the largest institutions or the largest pools of capital that have huge resources and really good access to information more generally, everyone else is going to increasingly have to operate in a world with more expensive data and more restricted and disrupted, sort of more dramas in terms of just even accessing data and even information through which to be able to make decisions. And I don't think anyone's really paying attention to this. And it's probably only because we have this, we spend so much time in data, especially over the years, that I'm starting to realize that this is actually a huge issue. About 12 to 18 months ago, we started to pivot and move towards a world where we are not dependent on anything that's government collected, anything that is at high risk of being a proprietary data set that could be either priced out of existence or withheld or gated, etc., and become less accessible. And then there's also issues with, well, anyway, we could talk about this for a while, but we pivoted to a point where we've developed tools and frameworks to be able to make, so with all of this capital flow sort of tools and the big money positioning and the different analysis tools that we have, we are basically more and more insulated from these data accessibility and pricing risks that are coming down the pipeline, which I don't think people appreciate. And so because we can do more with the same data sets, so we can pretty much run all of our capital flow and positioning, modeling, the whole works off exchange traded data. So securities exchanges just publishing their reasonably plain vanilla sort of data sets. We can do more with that data and get the insight that we're looking for that can empower investors and be largely immune to those trends that are potentially about to accelerate and catch a lot of investment firms and a lot of investors by surprise. And so that's a bit of a bigger story, but that's another thing where there's a lot of people not appreciating what is going on. And probably the third thing where a lot of people are out over their skis, like fixed income as an asset class over the next 7 years is going to become incredibly problematic, right? And that's a huge issue because fixed income markets, depending on how you measure it, globally, they're like a $300 trillion market cap sort of asset class, right? That's a lot of money. There's a lot of things in that. Global equities are circa 100 trillion in market cap, US dollars, depending on what month and whether we're up or down or whatever. The realities of both the passive strategies starting to be threatened by capital controls and stranded capital or impaired capital risks, combined with fixed income markets becoming increasingly problematic and at an accelerating rate over the next 7 years, even uninvestable in a lot of different areas and jurisdictions and regions. And this is related to having a sovereign credit default cycle kicking off and really escalating in the background around the world. You're going to have a lot of disorientated capital running around the world. We're going to have more of a fragmented global system to have to try and invest into or navigate. We're going to have all sorts of dramas, basically the next 10 years is just not going to be like the last 40. And now there are solutions to this, and that's where you need to get to the level of an individual market or security or asset class and be able to see where the money's coming in or going out. What are the actual liquidity conditions there? And what are the big money who have better proximity to information? What are they actually doing in that stock or industry or market or region, right? And more often than not, if at least you can monitor and track those things, you've got half a chance of staying slightly ahead of the curve on all of these issues that we're talking about, And so, and the ultimate form of currency is productive capacity or productive output. If you've got really high quality businesses that are producing goods and services that are in demand, you can pretty much sell them for whatever the popular currency is of the day, whether it be a nation state currency or like some crypto type thing or like whatever it is in the future. If you've got a capacity to solve real problems and create goods and services that are strong, necessary, have huge use cases for, that's the ultimate form of currency, right? And that's one of the ways to be able to weather the storm over the next 10 years when you've got issues around sovereign credit default cycles, fixed income markets becoming incredibly problematic, capital control risks popping up, jurisdictional risks, and so learning how to follow the money, see big money activity, bias a little bit more heavily towards businesses that are really producing goods that are have strong demand, basically, as simple as that sounds, that are actually going to generate profits and cash flows and all the rest of it. And then at the same time, be aware of the opportunities that are brewing in natural resources and precious metals and stuff, especially over the next 7 years. These are the sort of things. And if you get stuck in a jurisdiction or a region and you've got a restricted universe of securities that you can operate to, well, the same methodology works. If you can see the money in that restricted region that you're limited to in terms of a limited universe of securities, and you can see the money that's coming in and out or in and around that system and those securities, and what the big money's positioning is within that region or that restricted universe, well, you're still going to be fine. You still have a decision-making framework that'll keep you hopefully half a step ahead of what is going on.
Yeah.
And so, you just adapt.
True,
and at some
dynamic,
point over the next 10 years, sorry?
A true dynamic changing environment is going to be a lot of, as you say, very, very different from what we've seen.
Absolutely. So it's not for the faint-hearted, but there's ways to approach it. There's a lot of common sense ways actually to approach it. But and then on a 10-year time horizon, at some point, we're going to see some form of a tokenization revolution where everything starts to become tokenized and tradable in a sense. And are you prepared for that? How do you even, but funnily enough, it's the same principles, right? It's still learn how to track the money flows, because if everything starts to become tokenized, everything becomes a marketable security in a sense. Then do you understand those principles of how to triangulate money going into and out of, and how to identify larger, more informed money even within a tokenized environment, right? It's the same principles, it's just different things that are trading, and so there's lots of opportunity over the next 10 years, but it's a vastly different environment to anything we've ever known the last 40, and potentially the last 80 years even, if history is any guide. But
and there's always a train leaving the station. It might just be another train that we've been on for the last so many years. Is there a subject that you like to talk about that I did not bring up? That you think is interesting? Covered a lot of ground.
We have covered a lot of ground. Nothing comes to mind that wouldn't spark another multi-hour discussion.
Fair enough. Any parting words or to the audience? Where can people find you? Is there anything that you want to leave with them?
Well, if any of what we've talked about resonates, just jump on our website, prerequisite.com.au, and have a look at the early warning system page, and that'll whet your appetite, so to speak, to some of the concepts that we've talked about. And if anyone's interested in knowing more and actually seeing what this all looks like in a practical, data-driven way, then, well, reach out.
Yeah, awesome.
Yeah, jumping onto that website is probably the best way to touch base.
Yeah, awesome. Well, I found it to be a very interesting conversation. I want to thank you again for coming on, and I hope to do this again somewhere maybe next year or so.
Sounds good.
All right. Thank you very much.
Not a problem.